Well, hello, ladies and gentlemen, and today I have with me a very special guest, a good friend of mine. His name is Courtney Vincent. Courtney, I've known you for a few years. We have taught through Tax Watch University, and today we're going to be talking about the need to document business expenses. Today we're going to be talking about the need to track business expenses. Courtney, by the way, is from Memphis, Tennessee. You can see his background there. It says your community CPA. And I love that background. And you can find Courtney at Vincent Professional Services. You can Google them, you'll find them and get a whole bunch of knowledge. But Courtney, tell us the type of clients that you serve. Tell me about that.
Thanks so much, Brian. I feel as if I'm a jack of all trades and becoming a master of nothing, really. But man, I serve a lot of different industries, a lot of different client sizes, from your micro to your mid-size. I do a tremendous amount of consulting with startups, those with that are backed by venture capitalist dollars,
Oh, wow.
across all different industries. Yeah, across all different types of C corps, 1120Ss, a tremendous amount of LLCs that are just in this geography. So I just do a lot, just do a lot.
So you specialize, you concentrate with a whole host of different businesses. So we were talking about here today, and I don't know that a lot of people necessarily understand the importance of it. And that is the need to document business expenses. Tell me what you're seeing a lot of small business owners, the mistakes that small business owners are making, and why maybe it's even
Yeah.
important to document expenses.
Yeah, Brian, you'd be surprised. A lot of business owners have this view that accuracy is not important. It's this view that I can sort of thumb it and estimate and guesstimate what I've incurred. And there's this view in the community that the IRS is going to accept that we can round figures and come up with the total amount of utilities, or round figures and here's the total amount of the insurance. Oh,
Sure.
it's around this much. A lot of what I find myself doing is really trying to get them to see that, hey, estimating, while I understand it, it's not an art, it's not a science, it's just that. But we do need to get sort of finite in what we're putting on the tax return and what you're going to claim as an expense.
So
So
tell me, Courtney, are you seeing these types of issues with startups? You seeing it with businesses that have been in business for a while? And tell me where you're seeing it.
that's a good point. I'm seeing it primarily with startups and businesses that have not really adopted sort of like a QuickBooks or a general ledger accounting system. It's really sort of their homegrown system of just knowing sort of what they spend. But if you ask them the actuals of what they spent, it'll take them like, 5 years to come up with it. Because they just don't have they just don't have good records and good databases to really determine what their annual spend is by category. So it's a lot with startups and those that just don't know what the beauty of an accounting system can bring to them, how the simplicity of it, the organization
Ooh,
of it.
you just
Yeah.
said the
So
beauty of an accounting system. I love that. Let's talk about that. Talk about why it's important. I think it's more important. It's important for the IRS. It's extremely
right.
important for the IRS. But I think there's some other benefits too. So talk about the beauty of the accounting system.
Yeah, for one, the accounting system that's like the database. It's like the repository. That's like the storehouse where everything related to the business is stored. It's what feeds information reporting. And I oftentimes find that when there's not a good discipline that the client has with respect to organization, then an accounting system is going to be far from their mind. And so the accounting system, I like it because that's the tool that really helps shape their behavior on how they need to be disciplined about organizing their finances.
Ooh, that's
You
good.
know,
Organizing their finances. Yeah.
their finances got to be organized. You know, I'm still getting clients that have the shoebox, the proverbial shoebox. I mean, if we were to take a few steps over into my other part of my office, I mean, you would literally see, you know, banker boxes of detail. And it's behavioral. It's the psyche of how they approach business, whether they are fully overwhelmed, whether or not they don't understand it. But it's so easy to just take a receipt, throw it in a box, and not know at the end of the day about the transparency of the business. Are you profitable? Where are you making money? Where are you losing money? So all of that goes into the beauty of the accounting system.
There you
You got to
go.
have,
So one of the things I've found, Courtney, and maybe you found
yeah,
too, is that you have someone who starts a business and they're really, really good at what they do. They're really
right.
good at, let's say, maybe they're a tech company. They're really good at developing tech. They could be, who knows? They're just really good at what they do. And they
Yeah.
sit there and they go, man, I did not get into business to be an accountant. So tell me, what are some things that a small business said, man, I'm just not an accountant. I'm not wired that way. What are some things that tools or things that people can do to help keep track of their business expenses?
That's good. That's good, Brian. And as you know, and as well as I know, that we've all got those two extreme of clients. We've
Yeah.
got that one extreme where, you know, hey, they're zealous, they're excited, and they feel as if they can manage the business of their business and the back office. All right.
Yeah.
They've got 18 different personalities and they think they can do it all. So that's the one extreme, you know. Then you got the other extreme of the individual that says, you know, I'm gifted, I'm skilled, I'm talented in business development, really focus on driving the vision of the company. I don't even want to get involved in accounting. I don't even want to see the word accounting. I just want to sit back and get reports and know what it is that I need to pay at the end of the year in terms of taxes. So I think that the way that we find that happy medium is I always like to sit down with the client and say, hey, what is it that you need? Okay. What are you most concerned with? And a lot of that is really tapping into their temperament. If I get someone that's really, really, really hands-on, then it may be where I may introduce QuickBooks as the beauty of the accounting system, but I may not own every piece of it because they still want to put their hands in it.
Sure.
You got the other extreme. If someone says, I don't even want to touch anything, you know, I think that's like an accountant's heaven. Yes, I get to do everything. Bells start ringing. You hear the cash register, cha-ching. Just a great opportunity. But I think oftentimes I like to understand and have that dialogue to say, you know, what's going to make you satisfied to give you enough transparency about your business. And then I like to tailor a solution for that. Now, inevitably, QuickBooks oftentimes is my go-to. But believe it or not, some clients aren't because of their margins and because just the simplicity of their business. They're not a good candidate for QuickBooks. QuickBooks can be sometimes a sledgehammer as opposed to it being a thumbtack. I sort of like to just understand and gauge where you're at, what do you need, and then emphasize, hey, this is how we need to introduce this system whereby you're able to track your profitability.
So I think you raised a good thing on QuickBooks because again, QuickBooks is a wonderful tool, and I can't tell you, and Courtney, you probably know this too, how many people have QuickBooks and still manage to mess it up. It's not really their fault of their own, other than it's just they're not accountants, and that's okay.
Right.
For those smaller businesses that aren't maybe at a point of needing QuickBooks, what do you advise them to do and how to keep track of their expenses? Because again, they need to know where they're profitable or not, and then they have to know whether something's deductible or not. So tell us about that.
That's good. So I have a number of those clients that I come across every single, I'm not going to say year, I'm going to say every quarter, every month, whereby they've heard of QuickBooks. Someone has probably demoed it to them. They've even got the subscription and they're incurring the costs, but they're not even using it.
Yeah.
And when I find more out about their business, I find that, you know what, you're not even really the ideal for QuickBooks.
Yeah.
And so there are several clients, a lot of my retailers and a lot of my stylists, whether they're barbers or cosmetologists, those that are running, several of the convenience stores or what I call dry goods stores here in the city. I don't really put them on QuickBooks because here's another approach. Because I like to start with what I know the IRS is going to start with. I like to request a download of their banking transactions. I'll ask for not the bank statements, but I'll ask for their online credentials. I'll get them there, and guess what? I'll download CSV files, Excel files of their banking transactions. And we can do that quarterly, we can do it monthly, but that is a very good start for those clients that are sort of fee conscious or are just starting up and don't yet need the major artillery that's in QuickBooks.
Now, let's talk about this because, again, especially for a startup might not necessarily know the importance of even just having a separate bank account for their business, a separate credit card for their business. And if that happens, many times you can have personal and business expenses just get mixed. So talk about the importance for that, Courtney.
Yeah, I see it. I see it all the time. And here's where I see it, Brian. I sit down with a client and I'll say, how many dedicated business bank accounts do you have? And they'll say, I have one. I said, okay. I said, well, how often do you use that dedicated business account for personal? Oh no, I don't use it at all for personal. I don't use it at all. I don't run anything through that as personal. But then I'll get in there, Brian, and I'll start download transactions, and I'll start seeing every restaurant in the city. I'll start seeing every Home Depot charge and Lowe's charge in your service business. I'm like, okay, what is all this here? It happens. And my approach to that is I'll always sort of summarize what I think is inherently personal. And then I'll kick it to the client to say, hey, I want to challenge you to determining and looking at, is any of this truly business in nature?
Yeah.
And just as you would have to justify that for the service, for the IRS, I want you to justify it to me that this seemingly personal transaction is also business. And so I sort of put it on the client. And I'll help them work through that narrative if they need me to, but I see it all the time. And so I always tell them, especially for those that are organized as sole proprietors or even single member LLCs, have that business account, have that personal account, and figure out what do you need to live off of, and you just do those transfers as owner's distributions. And that has saved so many and has really given them the ideal of, hey, now I'm getting a salary and I don't have to commingle everything in the business account.
That's a really good point, Courtney. And I've always said to clients, and maybe you say too, is better for you to have this conversation with me, your tax professional, than with the IRS. And I would say to them, I say, let me be the bad guy and tell you we got to throw this out, because I'd rather be the bad guy than an IRS auditor. So tell me this, Courtney. One of the things that not everybody knows is, what is a deductible business expense? Can I deduct the picture behind me? Can I deduct those bobbleheads behind me? What is deductible as a business expense? Let's go there.
That's right. That's good. That's good. And as you and I know, the way we parlay this to clients is not by code section reference,
No.
and although we know, we look at, 162 and the case law related there, there too. I tell my clients this. I said, if you need to spend $1 related to your business, spend that dollar, and that dollar is going to be deductible. And I tell them, I say, if it's related to the business and it's clearly associated and it's clearly attached to the business, then it's going to be deductible. Now, clients don't understand that, the terminology of ordinary and necessary.
Yeah, what is ordinary and necessary mean?
Yeah, we don't discuss that. But I say, if the business needs it, get it, and it's going to give you a benefit. And I say, well, okay, so what if I go out and buy the Tesla Cybertruck? Is that deductible? I said, well, If it's ordinary, and if you need it, and if essential, then yes, it can provide you a deduction, but the manner that I get you that deduction is different than the manner that I would get you a deduction for a computer. And so I let them know that you don't be so caught up on, is it deductible? If the business needs it and it's an item that's going to be used exclusively in the business, then it's going to generally give you a deduction. If it's not exclusively going to be used in the business, then we can have some clawback of that benefit, whereby a portion of it may not be deductible. But that's sort of how I got my clients. And so even with that, Brian, they'll still say, well, what if I got to take a trip to the Florida Keys for a conference? And let's say, for instance, I enjoy a little bit of the sun and the beach and the waves or whatever the case may be. And I said, well, I tell them, there's not a line item on the tax return for enjoying the beach or the sun or the waves.
Exactly.
I say, but you went there for a conference, right? There was an agenda. You had to incur travel. And as we know, travel, for it to be deductible, it has to be documented. There has to be a place, a time, a reference point. I said, so save your airfare. Save the agenda, save your notes, anything that's going to evidence your attendance. Now, what you do outside of that, that's on you, but there's no line item for that on the return, but there is a line item to justify the existence of that as related to the business as a conference that you attended. And so you'll be surprised how many questions that we just get in the field of, can I deduct it? Yeah.
Well, let's go back to the Tesla truck for a second, because a lot of people, and it's maybe the most common question I get, maybe the most common question that you get is, should I buy my vehicle through the business? And again, talk to us about how vehicles are handled with the IRS and the benefits of owning it through the business and the drawbacks of owning it through the business.
That's right. That's right. And so the IRS knows that if you have a vehicle, the IRS knows that that vehicle is not going to be driven 100% of the time for 100% business purpose.
Yeah.
They know that,
and our clients know that. And you know that.
I know that. Because life doesn't work such that, oh, this is my dedicated truck. Okay, so you get in it this morning, you're planning to visit a client, but you need to stop and pick up your wife's dry clean. Well, that's clearly not business related. And so the use of transportation is not 100% business related. However, we still are provided some business use of that vehicle until the business use dips below a certain level. Now, everybody that's wanting a truck or a vehicle or an SUV, they're all concerned about writing it off. That's a very, very important benefit, very relevant. But now that bonus is diminishing, we're trying to find other ways to sort of provide benefit for the use of the vehicles. So bonus allows us to immediately write off the acquisition price or the cost of that vehicle. So it's like we're expensing it in a sense in the year of purchase, but that percentage is diminishing. We're phasing out a bonus, but we still get some of that write-off. Now, here's the thing. Depending on the type of vehicle, you're going to be subject to some limitations. So most clients, they know the bigger the vehicle, the more that write-off is going to be because it exceeds that limitation, that gross weight limitation. So I tell them, get the bill of sale, make sure that it qualifies, bring it to me. We'll look at what the benefit is. We'll ask you a few questions, okay? How often is this used in the business? What is going to be the intent for it? Are you going to put a contractor in it? Are you using it for business development? Because I want to make sure that we're clearly going to be over that 50% business use factor there.
So you just said the 50% business use factor. And you're right, that 50%, that's a magic number with the IRS, isn't it? Okay, let's go through this example. It's December 28th, and I decide, I deserve a Christmas present. So I'm going to go buy my big honkin' Ford F-150, whatever it might be. I'm going to buy that thing and
Yeah.
I'm going to drive it 50 miles for the year, and those are 100% business expense. Tell me the deduction I get that year if I buy that. Let's say it costs $100,000.
Yeah.
What's the potential deduction?
Yeah, that's a good question. So we've got bonus because it's a newly acquired asset, never been used in the business before. Somebody acquires that 2 days, 3 days right before the end of the year, they can bonus it, and they can do Section 179 expensing provisions with respect to that. So they'll get some benefit in the current year, and then on what has to be depreciated, then we step in and follow another set of rules with respect to that depreciation. They've been able to evidence that even in those 3 days, they use it for 100% of the time. So guess what? We meet the business use requirement, even though it's for those 3 days of the year.
And that deduction is, ballpark, could be potentially about a $70,000 deduction. So that's
right.
great. That happened this year, but then next year reality sets in. And I got that
Oh, yeah.
truck and I drive it. Let's say I drive it 10,000 miles.
Yeah.
And I come to you, Courtney, and I said, all right, I drove the truck 10,000 miles. You said to me, okay, Brian, what portion of that was business? What portion of that was personal? And I said, well, to be honest with you, Courtney, it was used 40% for business, 60% for personal. There's nothing I got to be worried about, is there?
No, there is some things we got to be worried about. Because we dipped below that 50%, we've got to go back and claw back some of that benefit that was recognized in that earlier year. We call that recapture. And so we've got to sort of take off the table some of that benefit that you claimed in that earlier year, because now that business use percentage has dipped below. A very, very bad answer. But guess what? It happens all the time.
You know it, bud. You know it.
Yep.
And that's kind of my point here is that, that's why when people do these things, and guess what? This is, in my opinion, Courtney, this is low-hanging fruit for the IRS. This is easy stuff to find. And that's why I think it's really important to document. Let's go with another thing. Courtney, have you ever gotten this question? All right, yeah. Courtney, I'm an S corporation, and I've set up my S corporation, and I've named as my board of directors my wife and my 2 children. And my 2 children are the ages, let's say, they are 8 and 5. So they're on my board of directors, and what we're going to do is we're going to go to Disney, and we're going to have a board of directors meeting. Tell us what's going on there.
Yes, Brian. That happens all the time. You've got a captive family. They're trying to justify an expense, and hey, let's get the whole family down to it could be where the entity is created in I don't know, Wisconsin, and we want to take a board meeting to California or Florida just to get to Disney. It happens all the time. And it's really hard to assert in that case. The 8-year-old and the 5-year-old, wow, they've got voting privileges. Oh, wow. They understand those they understand those corporate concepts. Oh, wow. They're the secretary, so they really have administrative oversight over that entity. Oh, and even it goes even further. For their board duties, they're going to receive some type of compensation.
So, Courtney, the reason I bring this up is because I think you and I both know, and I know people who are going to be watching this, they're watching it online, and I get that, but I think you and I have both seen some pretty creative tax concepts out there that are completely wrong. Yeah. And that's one of them, is the idea of putting your kids on the payroll. Talk about that. A lot of people want to put their children on the payroll. And I'm not saying that they can't put their children on the payroll, but talk about what needs to be done, if anything, if you put a child on the payroll.
That's right. You always have to keep in mind that represents compensation to the child. And now you've got a situation of, does that meet the instance where they've got a filing requirement? Because in addition to just income, they also could have unearned income. You've got, kiddie tax concepts, so it's a lot that goes into that. A lot of times you find it that if you're going to have your child on payroll, it needs to be justified. For instance, yep. Are they doing advertising? That's sort of the classic scenario. Are they doing something that is appreciable, enhancing the business? How close of a connection is the child performing services that the entity is receiving benefit for? Advertising. I see a lot of this occurring. A lot of clients are now paying children because, as you know, Gen Z, whatever the latest generation is, they're great with what? Social media.
Yeah.
So
let's call it what it is here, Courtney. I'm paying.
Yep.
This is getting out there based on my youngest daughter, and she's doing social media.
That's it. And she's they're driving content. They're influencing the public. And so should there be a cost associated with that? And I would say that there certainly could be, but we got to get we got to get the narrative right. It's all about the narrative.
Exactly. So it's not that these things aren't deductible. The big thing when paying a child, the big thing I see is that you can't overpay the child.
That's right.
You can't overpay, and I don't want to say just child. Maybe it's just family member. It could be it could be spouse. It could be whatever.
Right.
You can pay them, but it has to be a fair amount. For example, if I'm going to pay, you and I both have kids who go to the University of Tennessee. Go Vols, by the way.
That's right. Go Vols.
But I can't pay my child enough to cover the cost, for what they do. It's not valuable enough to cover their tuition, So, exactly. It's again, those things have got to be taken in kind. The other thing I want to talk about, we always think of doing these things, Courtney, from the standpoint of the IRS, and nobody wants the IRS knocking on their door. Right. But I think where people overlook and maybe don't think this through is one day you have a business, I have a business, our clients have a business. One day we're going to want to step out of our business. So Courtney, when we talk about selling a business, we look at the tax side of things, and for a tax side, we want to be as poor as can be. But yet when we show this to a potential buyer, we want to show, boy, look how successful I've been. So talk about the problems that people have if they are maybe being a little bit too aggressive with the IRS.
You're right, Brian. I see it a lot. Tax is a double-edged sword, right?
Yeah.
Yeah. Nobody wants to pay it, so they want to get income as low as possible. But that's the one document that is available for the IRS's review.
Yep.
That a potential buyer will request, so that they can sort of have those optic lens that get that insight to the business. So if you're showing that you're income poor on paper, but you're trying to realize a lot for the sale of your business, then that buyer is going to say, you know what, this isn't making any sense. Because the thought is, if this is how you ran your business, then if I were to acquire it and I not change anything, is this the profit that I would want?
Exactly.
In situations like that, Brian, I've found that, when I inherit a client and I get those prior year returns, I can see that, we pushed a lot of seemingly personal expenses through and tried to qualify them as being business related.
There you go. Well, Courtney, this has been a very enlightening conversation today, and I thank you so much for being part of the 1040 Files. Courtney, you can be found at
Vince Professional Services here in the Memphis, Tennessee area.
There you go. So go find Courtney and just encourage everyone to keep track of your expenses and go conquer your worlds. Thanks, Courtney, and thanks so much, everyone.